They're expensive for a reason. It's the highest profit growth. It's the best, or at least it was up until the craziness we're dealing with now with tariffs and all sorts of other potential risk raisers. But when you look around the world, Europe has a structural problem and has had that problem for a long time. We have a lot of advantages. We have the reserve currency. It's not a coincidence that all of the big tech companies primarily start here. I have a vivid recollection of a business trip in 2000 to London and Brussels. And in the US, during the dot-com collapse, you walk down the streets in Manhattan, the fear was palpable. Shit, if I get fired, I lose my health care, my kid can't get that surgery, Cobra is crazy expensive, I'm screwed. In Europe, it was kind of like, well, I got unemployment, my student loans, I don't have student loans, my education is paid for, my retirement is paid for, my health care is paid for. All right, so we have a recession, who cares? The flip side of that is you don't get the Larry Ellisons, the Bill Gates, the Steve Jobs in Europe the way you get them here. So sometimes stocks are cheap for a reason, and they can stay cheap for far longer than we would expect. 98 is kind of a warning. So that's number one. Number two, I'm not a fan of putting money into China because they basically say if you're not a local Chinese investor, you're a second-class citizen. And I think the numbers are from 1989 to 2023. You're essentially flat in China. I mean, you missed two of the greatest bull markets in history, and China gave you nothing because the B shares don't trade the same way the A shares do. And there's a lot of friction, unlike in the US. So I know everybody seems to think China is the big winner. It turned out the way to get exposure to China was not through putting money into China, but buying Australia, who supplied a lot of energy, a lot of commodities, a lot of things to China, and did really well on a much more steady basis without the Chinese centrally planned government putting a thumb on it. But the other aspect, and you and I have talked about what I'm about to say before, most investors never find their edge, right? 90+% of us, we have some idea as to what's going on, but really not a full understanding. We're overconfident, we're arrogant, we suffer from all the Dunning-Kruger effects, and so we make bad decisions. But some of us, and I include you in that group, have an edge. You have an expertise, digital marketing, content creation. Look at your successful history on the entrepreneurship side. If you can trade your expertise for entree into some of these alternatives where you're getting hey, let's swap, I'll swap not charge you a fee and you don't charge me a fee. That's a tremendous advantage that you should be very comfortable taking advantage of. When I first found you because of your presentation on The Four, which eventually became the book, The Four, and it was clear to me that you had a huge insight into these companies, even as late as the early 2010s. I would say check yourself and say, do I still have the advantage that I had when I bought these companies at a fraction of where they are today?
Let me ask you this. There's two big exogenous factors that I think you have to acknowledge and maybe adjust for. And I'm curious how you're adjusting your clients' portfolios to these two opportunities, risks, whatever you want to call it. The first is the Trump administration and all that brings, kind of, America first generously, or tariffs, however you want to frame it. And two, AI. How are you adjusting your clients' portfolios based on those two factors?
So let's start with AI first. And you and I are not that far apart age-wise. So we've lived through the financial crisis. We've lived through the dot-com implosion, what happened with the internet. I think we're both old enough to remember when desktop computers first came out. And there's this sort of land rush And by the way, this has happened with every technology. Go back to telegrams, radio, telephones, computers, internet, AI is no different. There's a rush to try and find the winners, the NVIDIAs. But what ends up happening is we're not a .com company, but every modern company today has a website, has email, uses business intelligence and connectivity to make themselves more efficient, more productive, more profitable. So with AI, the thought process is NVIDIA too expensive? Is it too cheap? When does Netflix and Microsoft and Apple, when do those companies achieve full value, overvalue? I don't know. I have no idea. People have been betting that it was over for forever, and they've been wrong. To me, what makes AI so exciting isn't the Magnificent Seven. It's the other 493 companies in the S&P 500 that every single one of them is going to be using artificial intelligence to make themselves more productive, more efficient, more profitable. And that's the upside. Sure, NVIDIA is a $3 trillion company. Is it going to be a 4 or a 5 or a 6 trillion? I haven't the slightest idea. But I can tell you the rest of the S&P 500 is going to benefit from AI and become much more productive. So that's your second question first. The Trump issue is kind of fascinating because there are two sides to this, and you have to be able to hold two conflicting thoughts in your head at once. The first is, if I'm investing for retirement, generational wealth transfer, philanthropy, I'm thinking out 10, 20, 30 years. I'm certainly thinking out beyond 2028. And so you have to kind of tune out the noise and look past all of the craziness that's going on today. But the flip side of that, and I've never met a one-handed economist. It's always on the one hand and on the other hand. But the flip side of that is there can be no doubt that risks are rising. This is a piece I put out last Monday, and we identified 7 areas where the possibility of risks, they're still low, but they're higher than they were before January 20th. And that includes the risk of a recession, the risk of a contraction in the economy, the risk of a volatility spike, which we've already seen. We're now over 23, which is a big, relatively higher number, not high enough to say, gee, I got to start buying with both hands, but it's above where we were. That was kind of steady. I'm concerned about the risk of the rule of law. I don't understand this nonsensical strategic crypto reserve. The world using the US dollar as the reserve currency of choice has been called America's exorbitant privilege. Why on earth would you do anything to put that at risk?
Sam, why is it put at risk with the Bitcoin reserve?
Why would you want to create an alternative to the dollar and endorse that? If you have an asset that's enormously valuable, you don't want to do anything to screw that up. And arguably, I try and think of Bitcoin as like a large tech company.